Good morning, happy Saturday. Hope you had a great week. Welcome back to the Broadcast Retirement Network's BRN Weekly, our weekly recap show today for Saturday, November 23rd, 2019. Last week, I sat down with Kevin Urso, president of Connected Technologies, and we discussed the risks to America's retirement system. Kevin laid out his thoughts regarding tips that you can use to protect yourself and your organization. Let's take a look.
So we have a list of just some top 10. These are must-dos. These are, just getting started. There's a whole series of things you can do beyond this. But number one, you got to have your staff go through some type of awareness training, at least annual. That awareness training now should be something where they have to take a little quiz at the end or a test to verify that how they're doing. And a lot of them, too, include phishing simulations, because phishing is one of the number one ways that an attack can happen. You're looking at a few hours. Now, the way to really do it well, if you take a course this month and you spend a couple hours on it, by next month, the month after, you've kind of forgotten about it or gotten complacent a little bit. The right way to do the training is you do maybe an annual training, but then have these little micro trainings that come in on a weekly basis to keep this information at the top of their head. So when they do get that email, I remember that training that I got earlier in the week. It kind of clicks. You should be doing an annual penetration test. So you should have a third party come in or try to get into your network externally. And then report that information to you. Were they able to get in? What could they find? What do you have that's good? What do you have that's not so good? So you can try to patch those holes. Strong password policy is very important. Do not let users use administrative credentials to access the network. Personal devices. You have to restrict personal devices on the network. And you need to be performing your patching and your third-party patching on a regular, consistent basis. So Microsoft obviously is the big one, but then you got to also think about some outliers like Adobe. A lot of people use Adobe in their network, so you got to think about those third-party apps that you use on the computer as well. They have to be patched because they're a point of entry. So if you're going to have a BYOD system, you need to have a management system in the back end that controls those, because they're a strong point of entry. So if you think about it, you're bringing that computer home or that device home, you're using it. Anything that happens there when you attach it to the corporate network can infect that corporate network as well.
Sustainable investing is really a hot topic for both individual and institutional investors. I wanted to learn more and sat down with Ryan Seberkel, Senior Vice President from Direction Investments. Let's take a look.
I think using the acronym ESG, kind of break down and give an example of each. But what we're talking about is environmental, social, and then corporate governance. So when we think about environmental, it could be things like carbon emissions. When we think about social, this could be things like executive pay versus rank and file employee pay, and how companies fall out on those metrics. And then if we look at governance, this could be more something like ethical business practices or things like that sort. It's very much a growing space. I think just a few statistics on a year-to-date basis. There's $13.5 billion of flows into ESG-related ETFs. So that's even surpassing kind of the AUM on the start of the year, more than doubling its size, just flows year-to-date. So certainly something that's getting a lot more interest out there. This is an interesting fact from the folks over at FactSet, just mentioning that on second quarter S&P 500 company earnings calls, the term ESG was 100% more often mentioned than via the first quarter. So it's very much top of mind. I think what you're seeing is a rise of a new generation of investors that kind of take these factors more seriously than maybe their predecessors. So it looks like something that's really gaining some momentum and looks to be here to stay. While it's something that's somewhat of a buzzword out there, there are some things to consider, of course. We're still kind of vetting out. ESG, there isn't specific guidelines for what exactly it means. Everyone has kind of their own interpretation. And, there's things that can be a little bit, you can see an ESG index that has energy companies present. And, you kind of scratch your head as to why, but these could be energy companies that are much more kind of leaders amongst their group in managing the negative outputs of their business. So it doesn't mean, it's just strictly exclusionary. It can be inclusionary in the sense of finding companies that actually are kind of doing the best in their industry on some of these factors. I think a lot of it is still to be determined. We do have a lot of data, but a lot of these factors that we're trying to kind of hone in on, we still don't know if they're going to be, down the road, kind of the prime determinants of whether or not certain companies in a certain industry are successful. I think if you look at tobacco, for example, in retrospect, something that we know does great harm to society. And now we see something like vaping getting such a very quick response and, from regulators. So who's to say whether or not that's going to, 20 years from now, we'll look back at vaping just the same and say, well, you know what, that was spot on. Or maybe it's a little bit reactionary. So to some extent, some of these factors, time will tell, and how things shape up.
And when we come back, cryptocurrency is also a hot topic, and we sat down recently with Delphi Digital's Kevin Kelly to discuss this and a lot more. So stay tuned right here on BRN Weekly. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network. Welcome back. And as I said when we went to break, cryptocurrency is really a hot topic, whether it's Bitcoin, whether it's blockchain. We covered here on the program. And I recently sat down with Delphi Digital Research's Kevin Kelly. He's the co-founder there. And we discussed some of the regulatory hurdles that exist both here in the United States and abroad. Let's take a look.
Starting with the IRS, as you mentioned, you have seen some more clarity come around for investors and traders of crypto assets in terms of how to actually recognize some of those gains or losses, for that matter, on the assets that you're trading or investing in. Kind of one of the big things that has been up in the air and is still largely up in the air, but we've gotten a bit more clarity on recently, is when it comes to some of the unique kind of nuanced features of these crypto assets, right? One of which being what we call a hard fork. So basically, essentially what can happen sometimes is if you don't reach consensus on a certain blockchain, oftentimes the blockchain itself will actually split, right? And so what that oftentimes creates is two different currencies. You have cryptocurrencies. You have the original on the original blockchain, but then this kind of split cryptocurrency. Oftentimes, people that own The original one will also get, we'll call it shares or portions of the new crypto as well, right? Almost kind of for free just by holding the original crypto asset. And so what's interesting there is, and the IRS is trying to tackle in some of the recent statements, is how do you actually account for that, right? Is that going to be considered something that's income? Is that more so like a dividend? I mean, obviously, when it comes to the nuances of this space, these are things that the IRS and regulators are trying to tackle in real time, because it's simply, something that we've never seen before. It's the benefits, but also the challenges to a new kind of emerging asset class. So as of right now, it seems as though, it's going to be hard forks and new crypto assets that get either airdropped into people's wallets or whatever it may be, are going to be probably recognized more so as kind of income rather than trading these things or having it under the capital gains type tax, where obviously you can take advantage of lower rates if you hold on for longer periods, and depending on what your tax bracket is. So I think that's kind of a little bit of the clarity that we've seen. I mean, depends on, again, kind of what your wealth level is, how involved in crypto you are. There's some people who've been kind of up in arms about it because, again, it's basically them trying to recognize or take more tax revenue from something that, they largely probably don't understand the full kind of nuances of.
Yeah.
But at the end of the day, I think it certainly is at least pushing the ball forward to give people clarity, because it's one of those things that's held people back. If you have to, 2 years ago, if you're trying to figure out during that whole, 2017 rise up of the ICO boom and all that, trying to recognize your taxes and figure out, what you owed and what your kind of base rate was and all these types of things was extremely, extremely difficult, right? What your entry point would be. And it was very, very tedious, and it still is to this day, but, we're long story short, slowly but surely getting there where this process can be a bit more automated. I mean, if you think about just kind of the game theory around creating regulations and kind of limitations around some of this technology and what you're able to do with it, what you're able to invest in, what you're able to trade, how that's recognized, it all adds up, right? So if you have some of these more, we'll say, lenient countries when it comes to the regulatory landscape for crypto, I mean, that's obviously going to attract a lot of people who, especially if you're kind of crypto-centric or the original kind of crypto enthusiast, the entire ethos behind this was really kind of built on the idea of sticking it to the man, right, or being kind of anti-establishment, for lack of a better word. So you're going to attract, a lot more kind of innovators to those types of regions that have probably not for necessarily malicious reasons, but that have a little bit less scrutiny when it comes to the crypto landscape. I think one of the other thing that's interesting too, and you bring it back to agencies like the SEC, right, which by and large is there to ensure that your average investor doesn't get duped, doesn't not necessarily saves them from making bad investments, right, because everybody can make bad investments, but really trying to filter out the noise and the scams that can come with the crypto space. You start to see a pretty large crackdown, or at least a few pretty large crackdowns recently on some of these larger projects that actually issued what the SEC has now deemed unregistered securities. And so that's certainly a trend we think is going to continue. And it's one of those things where when we're looking at this space and looking at individual crypto assets, you have to take into account, you have to discount for the potential, regulatory risk that somewhere down the line, the SEC finds these things, as being sold as unregistered securities. When you think about the wild west of crypto, right? And we've certainly come a long way over the last couple of years, but nowhere near, an established asset class like the equity market. I think it has certainly, deterred a lot of institutions from getting into this space, but there's two sides to that coin, right? You have on the one end, I think a lot of the smaller kind of crypto assets, or even some of these larger projects that are now coming to market with kind of live products. There's still a lot of, again, scrutiny or uncertainty around how these things are actually going to be looked at or viewed by the SEC. But at the same time, when you look at something like Bitcoin or now even Ether, which is the native crypto asset for Ethereum, the fact that those are now considered, commodities and sit outside the kind of securities regulatory framework, I think has also been a boon for institutions that are trying to look to diversify even away from something like Bitcoin, right? And again, whether or not Ethereum becomes these kind of big smart contract platform, a lot of people think it will, or is the top smart contract platform long term. That's obviously still up for debate, but I think it does give a bit of a kind of almost regulatory moat to some of these projects that can actually escape the securities regulation, and for good reason, right? I mean, I think Bitcoin, especially, Ether at this point, I mean, they're certainly more traded as commodities than, true blue securities. So at the same time, it kind of depends on which side you're sitting at. Is it good for smaller crypto assets? It's probably a little bit tough to make the argument that institutions will want to get into that space. But more regulatory clarity, obviously, is a boon for institutional investment kind of at the top of the funnel, because now you have some more clarity around, how you can invest in these things, hold these things with custody, things of that nature.
And in our last segment this week, I sat down with Daniel Klein. He's a senior technology and consumer products reporter with The Motley Fool, and we discussed robo-advisors. Should you love them or hate them? Let's take a look.
So basically what this report came out and said is that robo-advisors can never fully replace real advisors because of the trust factor. Because eventually, if you were my financial advisor, you might have told me something. 6 months down the road, I might go, oh my God, that saved me money. That made me money. And that's not something sort of that can organically happen with a robot. So again, I believe robo-advisors have a place. They can sort of tell you how you've allocated your money, if you've made mistakes. What they can't tell you is, hey, this might be the right stock for you, but geesh, I don't want to own that. That's a company my values aren't in line with. Mm-hmm. Or, all right, you're telling me Starbucks is a company I should own, but boy, I get my coffee at Pete's. I don't really align with sort of what they're doing. That's not true in my case. I'm a Starbucks fan, but you understand the gist of it. There's a human piece of it that, of course, AI can eventually pick up some of that.
Right.
But I don't think you'll ever trust a robo-advisor, no matter how advanced it is, as much as you trust a human. And part of that is, I think we're more forgiving if a human makes a mistake. I think what we're seeing is your personal ability to know where your money is, what your money is doing, and what it might look like in 30 years. That's absolutely more advanced than it's ever been, and it's going to get better. So we run stories at the Motley Fool like, what would happen if you spent $1,000 on this company's IPO and now it's 20 years later, here's what it would be worth. But you'll actually be able to really easily run those models. So if you decide like, hey, you know what, the next hot company to IPO, I really love that brand, I'm gonna spend $1,000 and buy a few shares. Well, what would that have to do over a 10-year period to justify taking that out of, say, a traditional safe investment, a Microsoft, a blue chip stock that pays a dividend? So you could really weigh the pros and cons. And now, like when you go in and program your 401k, you might be able to pick like, I'm young, so be very risky. I'm close to retirement, so be cautious. You're going to get much more fine tuning and a larger understanding of what you're buying, and maybe more of an ability to say like, you know what? I don't want to invest in any company that pollutes. I don't want to invest in any company that does things that don't align with my values. It might be any company that sells meat or any company that doesn't sell meat. It really depends on your values. And that's where the robots are going to help. They're going to give us an ability to sort of process things that would be challenging for humans. So it depends who you're talking to. Like many of my colleagues who have CFAs and I don't know all the degrees, but various certifications so they can manage money. They have the ability to integrate technology because it's a native part of their life. Anybody under 35 who's moving into financial planning or stocks or any of that sort of area, they have held a phone in their hand for their entire adult life. So they're going to know what's out there. They're going to use those tools. I would think that if you work for a big firm, chances are those tools are available. And if you're not comfortable using them, there's probably someone who's 28 in your division who knows how to do it. That said, I do see an older generation of, quote, accountants who are very rigid, who don't sort of know how to play the loopholes, don't know how to do some of the games. And you have to check, is my advisor, is the person I'm working with staying current? And that might not mean using AI to help you figure out stuff, but are they reading? Are they on top of things? You can replace the AI work with legwork, but are they doing that legwork? Do they have all the things available to them? I see sometimes with various people I talk to that have used the same person year after year after year, and that person maybe isn't staying up to date on the codes and some of the rules. So you really want to put it to that test. I mean, we've all done it. You look at your portfolio and go like, why did I have 20% of my portfolio sitting here in this area that's been languishing forever? It's something you personally have to look at, not obsessively, maybe twice a year. If you're closer to retirement, maybe 3 or 4 times a year. And it's just to make those tweaks or to ask the question, hey, I've got 20% of my money in municipal bonds. Why is that? Wouldn't that be better off in tech stocks? And the answer might be yes, it might be no.
And that wraps up this episode of BRN Weekly. Don't forget to watch us Monday through Friday on BRN AM. And also don't forget to check out tomorrow's podcast, BRN Sunday, where we delve into all the news in retirement markets, technology, personal finance, and so much more. Next week, it's a short week for us. We'll be off on Thursday and showing a best of episode of BRN AM on Friday, but we'll be right back here on BRN Weekly on Saturday. So until then, I'm Jeff Snyder. Keep on saving, and don't forget, roll with those changes.
Waiting here for you to take and drink of. But if you're tired of the same